Okay, welcome everyone. Hopefully you can all hear me. I'm Dean Best, editor of justfood.com. Before we officially kick off, I'm going to run through some housekeeping points to ensure everyone can hear the webinar and post questions during it, which we'd very much all like to receive. So please have your questions ready for later on in the webinar. Just moving to the next slide. Okay, so I'm going to read these instructions as well. Obviously, you've got the opportunity to read them here. Your phone is going to be in listen-only mode during the call. The hosts and the other participants will not be able to hear you. If you wish to use PC audio to listen to the webinar, please select Allow when you see the message on screen, aroc.enterthemeeting.com, wants to use your camera and microphone. If you have trouble hearing, please check your audio option to the left and make sure you've selected Listen Only, which you can see via this graphic. There we are. If you enter the meeting and you see a message that says Java needs your permission to run, please click on Run this time. So I'll just leave this slide up for a minute or two, just I can see more people are joining the webinar. Right, okay, I'll be given the nod from our technical guys, so let's begin. Good afternoon, welcome to the results of the third annual Just Food Confidence Survey. If you just joined the call, I'm Dean Best, editor of justfood.com. For the next 45 minutes or so, we'll outline how our international readers see the trading environment for the food sector panning out in 2014. This is the third year we've run the survey. Last month we asked our readers for their views on a series of issues from consumer confidence to prospects for growth for their businesses, M&A, NPD, sustainability. Over the next 10 minutes or so I'll provide some of the sort of macroeconomic results. With me on the webinar I have Rod Street, formerly of IRI and PwC, and now a strategic consultant for the FMCG sector. Rod is joining us for a third year and will provide his own take on the results of the survey and outline what he believes are the challenges and opportunities facing the sector. I'd also like to welcome back Charlotte Ashton, Business Development Director for Palatine Private Equity. Charlotte provided key insight on last year's confidence survey webinar when she was at Grant Thornton. Today she will pick out what she has seen as the key findings from this year's survey with some focus on M&A. Slide to change. There we are. So my first slide, it's like turning the corner. So I think before I start going through some of the results, perhaps we should take a quick look back at the context in which our readers gave us their views. As we moved through 2013, there were signs the macroeconomy in a number of Western markets was turning the corner. The UK started 2013 fearing a triple-dip recession, but it moved into the autumn with George Osborne pictured there talking about tentative signs of a balanced, broad-based, sustainable recovery. And the UK ended the year, on some counts at least, the fastest growing large developed economy. By the end of 2013, consumer spending over in the US was rising at its fastest rate since 2010. Home prices were climbing at their fastest rate for 7 years, and there was the biggest gain in employment for 7 years. And there was even some recovery seen in continental Europe, long bemoaned by CPG companies. The Eurozone squeezed out of recession in the second quarter. There was some growth in markets like France and Germany last year. And for the first time in nearly 3 years, in the fourth quarter of 2013, the 6 largest economies in the Eurozone area saw their GDP grow. That said, unemployment in the Eurozone reached record highs in 2013. So there's still the feeling that even if the recession ended in the UK, Europe, and the US, in some ways a consumer recession still pervades. For many consumers, food prices continue to outstrip wage inflation and have done so for more than 5 years now. And that's buoying price-led growth in many markets, particularly here in Europe. as exampled by the growth of Aldi and Lidl in the UK and Ireland. And looking at the market as a whole, there is continuing pressure on food volumes and competition is intensifying. So here in the UK, since the start of the year, we've seen the likes of Tesco, Asda, the Co-op, and most latterly Morrison's announce significant investment in price to try to win back custom from the likes of Aldi and Lidl. Move to the next slide. That said, Just Food's 2014 confidence survey showed a definite feeling of optimism among our readers. Close to 60% believe the operating environment will improve in 2014. A 2013 survey saw a much lower number, about 37%, predict better trading conditions year on year compared to 2012. There are some that believe trading conditions will worsen this year, but that's down 6% compared to 23% for both 2012 and 2013. Move to the next slide. Consumer confidence. 53% of our respondents saw consumer confidence growing in 2014. And that is an increase in 2013 when 37% said consumers would be more bullish year on year. A third of those surveyed believe confidence will stay at the level seen in 2013. And again, there is a cohort, a minority, 15% in this case, who argue that consumer confidence may dip a bit. Nonetheless, again, I believe this result demonstrates a sense of broad optimism in the food industry. Why could that be? Well, I guess the confidence stems from some of the recent data sets we've seen in the UK, the US, and at least some parts of Europe. This week, the inflation figures in the UK were announced, and inflation's at a 4-year low. Economists believe wage growth will at last outstrip inflation at some point this year, bringing an end to, I think, a 4-year fall in pay in real terms. There was a consumer confidence survey out from GfK on Wednesday or Thursday this week, and that suggests shoppers feel more upbeat than any time since August 2007, i.e. since before the financial crash. Grocery sales in the UK have also taken a turn for the better between January and February, according to the ONS. Across the channel, economists have forecast German GDP will pick up this year. And a confidence tracker published today from the US investment bank Sanford Bernstein said consumer indicators in Germany were positive, and they pointed to an uptick in retail and food service sales. Over in the US, GDP figures for the fourth quarter of 2013 were yesterday revised upwards, I think with the Commerce Department pointing to a surge in consumer spending, which shouldn't cheer your heart. Focusing on the US for a minute, there have been some slightly downbeat financial numbers published by some of the major corporates over there. General Mills last week posted quarterly numbers that missed forecasts. They cited the poor winter weather, but also more critically, generally weak food industry trends. However, their CEO, Campbell, he said consumers were, although they were drawing down a bit from their own pantries in that quarter, he saw the US economy slowly improving and income slowly strengthening. So that should be cause to cheer some of your hearts who may operate in the US. Looking ahead though, back on this side of the pond, will the upturn in consumer confidence here in the UK continue? That uptick in grocery sales in January and February, some believe that rise here will be short-lived, with the likes of Tesco, Asda, Morrison's lowering their prices to fight back against discounters. In Europe, unemployment is likely to be stubbornly high. So there are no doubt challenges remain. Let's face it, consumers are still cautious. There's been what's called a barbell effect on incomes, with the numbers of low income and high income consumers increasing and those in the middle falling in number. Consumers are shopping less. That's a fact. But they're shopping in more stores with non-traditional outlets like the discounters, like the sort of dollar stores, general merchandise value-led retailers like Poundland coming to the fore. There are opportunities there, but these consumers' trends indicate that CPG companies will have to adapt. Moving on to specific regions and how our respondents viewed trading conditions in the likes of Europe, Asia, UK and North America. So when we asked our readers specifically where they believe trading conditions could improve in 2014, it seemed to me that the optimism that was indicated by the kind of broader question slightly diluted. Respondents here could provide more than one answer. UK and North America came out on top. I think 30% saw the trading environment improving in these markets in 2014. That's still relatively a low number, really. Only a quarter believed conditions would improve in Europe, perhaps an indication that a consumer recession still lingers, even if the economies in the Eurozone technically moved out of a recession in 2013. A recovery in Europe is likely to be slow. The survey suggests that there is a belief that markets in Asia will bounce back after what was something of a slowdown in 2013. 47% of our respondents chose Asia as the region where they were most confident trading conditions would improve. Now, emerging markets did slow last year. Unilever issued a much publicised sales warning, effectively not profit warning, sales warning last autumn, and specifically cited slowdown in emerging markets. And reading some of the recent macroeconomic commentary around China, there is broad consensus that GDP over there will remain below its historic growth rate this year. But let's face it, China's economy is still projected to grow above 7%. The country still presents a significant opportunity for food manufacturers operating in the more depressed, moribund Western markets. Growth's not at the level it once was, but some of the headlines last year around the slowdown in China were, to me at least, overdone. Which takes us on to our next question on emerging markets. We asked, which emerging market do you expect to offer greatest opportunities for growth in 2014? China and India led the poll. India was the most chosen market slightly, just under 24% of respondents chose that, over 23% for China. And that's despite there being some concern over the prolonged, again, relatively speaking, prolonged slow economic growth seen in India when compared to previous years. I guess the country's middle class of 300 million must be appealing to CPG manufacturers. Brazil was third, just under 16%, which to me was a little surprising given the potential consumer boost that could be provided from this summer's Football World Cup. The standout result, though, for me was on Russia. Just 6% saw Russia as the emerging market that offered the greatest opportunity for growth this year, and that's down sharply from 20% in last year's Just Food Confidence survey. I guess the result could be an indication of the uncertainty caused by the political crisis in Ukraine. Sanctions on Russia started just after this survey was closed, but in January, Moscow itself was casting doubts over the country's economic outlook this year. As I'm sure we all know, Goldman Sachs' Jim O'Neill was the man who coined the term the BRICS a decade ago. And for the first time this year, we gave our readers the chance to choose one of his new group of emerging markets, so-called MINTs, which is Mexico, Indonesia, Nigeria and Turkey. Of those four markets, Turkey was seen as offering the greatest opportunities for growth in 2014, although the numbers for each of these four remained quite low. 7% chose Turkey. 4% chose Nigeria, and West Africa was touted by a number of readers who chose to select another option on this particular question, which was defined as other. Now, Africa is obviously very much a longer-term play, but there have been some notable investments in the west of the continent, particularly in recent years, most notably from McVitie's owner, United Biscuits, which invested in a local snack group there in February. So this question produced something of a mixed poll, but that in itself indicates the industry sees various options for international growth, which I think is some kind of a positive. Another question in this year's survey asked if readers planned to increase their investment in growing their business internationally. 53% said yes, up from 50% last year. And finally, the final two slides for me, I'm going to move on to another area of investment, sustainability. I mean, Rod and Charlotte will look at other questions asked in the survey around revenue, profit growth, NPD, M&A. But I wanted to highlight 2 questions on this particular issue, which is vexing more minds in the industry than ever before. So looking at this slide, in this year's survey, the number who said they would up their investment on sustainability projects increased. If you look at the group of the bars on the right-hand side, there was an upturn in those who said they would spend more than last year on sustainability. That number this year was about 43%, and that came after a year-on-year fall in 2013 compared to 2012. So, I mean, as in the previous 2 surveys, a majority still say they would only match the previous year's spend, but that cohort is shrinking. And I think this could be an indication of the broad improvement in business confidence year on year, as indicated earlier in the survey. However, there is, or at least should be, a growing awareness that investment is needed in sustainability. In another question in our survey, over 70% said their commodity bill would rise in 2014, and the long-term direction of commodity prices is only going one way, and that's up. A greater focus on resource efficiency makes business sense, or put it another way, good business in an ethical sense is good for your business. Moving on to the final slide from me. This question specifically looked at our readers' sustainability priorities for 2014. This is a brand new question. We asked on which key sustainability issues do you expect to focus in 2014. It was a multiple choice answer. Over 40% of respondents all chose 3 things: sourcing of commodities, waste and packaging. So there has been a flurry of initiatives around announced in recent months on commodities like cocoa, palm oil from the likes of Mondelez International, Hershey, Mars, Unilever. So perhaps sourcing wasn't too much of a surprise. Focusing on waste has reputational and efficiency benefits and is something of a no-brainer for economical reasons, really. It's just always surprising that it wasn't a higher priority sooner, but the tone was set within the industry last year. There was a flurry of announcements on waste. Tesco was at the forefront here in the UK, and it should remain a high priority for a long time to come. Only 17% say they are focusing on carbon, and I think that's partly reflective of the fact that carbon is a relatively mature issue in this field. It was perhaps the first issue that many food manufacturers would have focused on, and programs for tracking carbon use and looking at how to mitigate use of carbon and its impact are already in place at most companies anyway. Looking ahead, water use looks set to grow in importance. 29% of those surveys chose water use as an area of focus this year. And with the global population set to swell to around 9 billion by 2015, food security, I think, is now commonly discussed in the context of other environmental issues in what is becoming known as the food, energy, water nexus. So with that, over to Rod.
Well, good afternoon, everybody. I'm going to give you perhaps a bit more of a strategic and economic perspective on some of the outputs from the survey. I've given it this title, Growth with a Sharp Edge, and I'll describe a bit more what I mean by that. I think it's interesting the timing of the survey this time round, because very much as Dean said, it's come at a bit of an inflection point in that everybody was terribly tentative over what they felt about the economy in 2013. And things seem to have strengthened towards the back end in a number of geographies. And that is something that you can see picked up. Particularly, you can see it in consumer confidence, and you can see it especially in businesses. So I think the first takeout is, for me, that confidence has finally started to build up a bit of momentum, but it's a very gentle return. The overall confidence in the environment is increasingly secure. People see the economy as having survived this tremendous downturn that it's seen over the last, it's actually 6 to 7 years that we've had this uncertainty and problems all around the globe. And they see consumer confidence bouncing back. And actually very few see downside risks this year. Now, the interesting thing I find about that is if you actually were to go to the OECD, the IMF, and look at what they're saying, they are much more cautious on the downside, particularly around the shift in policy. Because what most consumers and indeed many business owners perhaps don't see is the huge amount of support that has come in the advanced economies from the public sector. And that's come in terms of monetary stimulus and also in withholding fiscal adjustment. And both of those things are just beginning to move back. So you've seen the US beginning to taper on its monetary policy, and you can see places like, for instance, Japan, which had a big fiscal boost last year, is just starting to rein in again now this year. And I think the downside risk is, can the private sector demand actually pick up as the public sector begins to tighten things up over the next 2 years? And I think economists are much less clear that that's a done deal than comes out in the survey, to be honest. But because of that confidence, the confidence drives kind of everything. So as confidence has strengthened, so has investment. And you can see, if you look at the pattern, that this year versus previous years, headline investment is growing, investment in R&D and innovation expenditure is also growing, and people are pushing out more products. So there is a real drive to actually exploit the upside that's coming in terms of the market, and that sits alongside kind of continued investment in things like multi-channel, which is perhaps the strongest theme you would see if you were to talk to a lot of the European retailers. And because the confidence is there, there have been some nudges on the tiller. So if you were to go back, and this isn't just in the Just Food survey, but you'd see it in almost all comments on consumer and shopper sentiment across the advanced economies, and indeed into some of the emerging economies as well, tremendous importance of the price-value equation and a real drive to get more for less. And that comes out, as Dean said, in terms of the patterns of shopping, which are smaller shopping, more visiting more shops, trying to cut less waste. You can see it in the problems that the hypermarket formats had over the last 3 or 4 years. That's still there, and that's clearly still there. But the thing I found interesting is this jump in terms of the focus on quality and the innovation in terms of looking more for quality. And I think that's a theme that is going to come much more strongly over the next few years because of some of the other things that have come out, particularly things like the food safety scandal that has happened right across Europe, and also because of the sort of trade-offs that consumers have been making over the last few years to make ends meet as GDP per head has dropped. And you can see it also in terms of sustainability, which I have to say I thought had been put kind of firmly on the back burner by the recession, and that's clearly springing right back to the fore in people's minds. So takeout is confidence returning gently. But I think there are some challenges that still remain if we go on to look at those on the next slide. And it's not just about growth. It's actually also about other things. Can we move the slide on? Yeah, so what you're actually seeing, if you were to do a little bit more of a dig, and you see this also in some of the forecasts, whilst there is more confidence in growth for 2014 than in 2013, you're not seeing a materially significant lift. And in fact, the engines for things being better in 2014 are economies like the UK and the US, and they're tremendously dependent upon consumer expenditure and sentiment. And those are not sustainable bases for growth. And that's coming at the same time as a lot of the emerging economies have got a cyclical downturn. So you're seeing slower growth in places like China. And you've seen some of the newer geographies that I think people felt would have picked up speed and helped take things forward, not featuring quite as strongly. You can see problems in a number of the BRICS. I mean, Russia and Brazil, and there've been even problems in both governance and finance in India. So you're seeing quite a bit of uncertainty still there, and globally we're tremendously dependent upon emerging economies, which are now over 50% of global GDP. So growth and opportunity, it's a bit stronger, but it's not materially much better than 2013 in terms of most of the expectations. It's just this confidence wave sitting behind it. And that, I think, leads to a couple of pressures in the system. One is that profit, and this comes out in the confidence survey, profit growth is going to lag behind revenue growth, reflecting the incredible pressure that is retained in terms of competitive pressure, category on category, and economic pressures on businesses. And you can see that in the survey, and you also can see it in different tilts in the news. I mean, you look at things like the attacks that have been on PepsiCo and P&G in terms of their overhead structures and the amount of money that is being spent on their current governance and the need to reduce costs and restructure or to spin off the different bits of the business. And you can see it also evidenced in what people are feeling in the survey by this squeeze between demand and supply side prices, the expectation that commodity prices will kick up. And I think that's a very important feature to bear in mind in terms of the implications of the survey. Then secondly, there are these pressures in the system. The recession and the strength of the recession has held back a number of factors that have been present and pushing for quite some time. They've just been pushed into the background. And you can see people seeing those are going to ratchet us off the minute that the economy is a bit better. So you've got this long-term shift in terms of commodity prices that because of global demand and increasing prosperity around the world, which is a good thing, that's actually driving demand for commodities up. And almost no pundits can see on quite a lot of commodities that are relevant particularly to the food industry, an easing on price pressure there, even if there is some cyclical benefit from downturns or slowdowns in the emerging economies. And then you can see these other pressures, particularly relevant to the food industry, one on food safety and the need to make sure that you've got a tight supply chain, and the importance of provenance in consumer demand and local, and the opportunities that provides, but also the pressure it puts on people to make sure that they're performing well on these criteria. And then secondly, sustainability. And the big one, I think, there is it's not just packaging which comes out in the survey, but also water which comes out in the survey, which the industry has had sight of for quite some time. But I think you can see that is going to play even harder if you were to look at things around particularly some of the food harvests and the weather shifts that we've had over the last 2 years, which we keep saying are exceptional, but which keep impacting food. So moving on to my last slide, and just thinking about what this means and what I would take out in terms of implications. I think the first thing I would say is that it becomes very, very important that businesses think not just about gaining incremental volume as opportunities open up, but actually securing positions in markets in the categories that they're operating in. The actual economics of products are going to remain challenging. If you're in Europe, you've obviously got the growth in channels, many of which are price sensitive. So the online growth, whether that's home delivery or click and collect, and also the discount channel, which have fared particularly well wherever GDP per head has been squeezed. Those are going to continue to put an awful lot of pressure, not just on the retailers, but also on their suppliers to be able to maintain lower headline prices. And that's going to be seen in continued cost pressure and resistance, I think, from the consumer to any adjustments that people want to make in terms of pricing and premium positioning. And with the cautionary sort of hat that economists retain on the downside, and the fact that as consumer expenditure cannot continually be financed by borrowing, and we are still phenomenally in debt across the advanced economies, it's going to mean that if you are supplying the food industry, you've got to make sure that the economics of the business itself and the overall cost structure of the business remains very tight. What that means in terms of securing position, I think, is that success, particularly over the medium term, is going to demand what I call a better product. And it's something I did talk about actually last year. I think it was evident there, but I think it becomes even more important as things open up. People think of differentiating products, but the most important and the most significant brands in almost all categories are actually the ones that excel on the core pillars that the consumer buys the category for. So consumers, particularly under the economic pressures that they've been under over the last few years in most of the advanced economies, and their sort of drive to frugality, have started to interchange products within categories much more, just in the same way as they had started to interchange shops and shopping missions. And the people who do well in that are the people who deliver on the core pillars of what the consumer wants in a category, be that things around taste or provenance or ease of use, whatever it is. And it's going to be very important, I think, for suppliers to work out and dwell on the things that will deliver a competitively better product on that. And that's what I call a real differential advantage. At the same time, that's going to have to be delivered by wrapping it round and seeing how the product delivers money back off the shelf. So that's not just headline price and margin, it's also turn, so that you're getting the kind of returns that you need that secure your distribution position, and which the retailers badly need in terms of the pressure that they've got in maintaining prices in what remains a very difficult environment. After that, I think what I've described here as longer-term growth bases should also be looked at, but those are not necessarily require a lot of investment. It's more about working out where innovation needs to go next. So in conclusion, I think the survey itself shows a sort of gentle confidence return, but what I think it also shows is that the whole economics of making money remain very tight, and the priority that needs to be given to securing those fundamental economics in the way that they come back off the product. Thanks.
All right, next up we have Charlotte Ashton, who's the Business Development Director from Palatine Private Equity. So over to you.
Good afternoon, everyone. First, I thought it would be useful just to give a little background about Palatine. We are an independent private equity house, owned and controlled by the partners, which means also that the deals are led by the decision makers. We raised a 100 million maiden fund in 2007, and that's fully invested with 9 deals to date and 3 exits from those 9. The second fund was raised last year, June 2013, with 150 million to invest. 10% of those funds raised were from successful entrepreneurs, which is really important as part of our proposition, because we use and work with those entrepreneurs for a lot of the investments that we make. And we have a few entrepreneurs who are from a food sector background as well. The equity check size is between 10 and 25 million, and we have a food sector focus from an origination perspective, hence why I'm talking here today. So moving on to my first slide. I think just supporting what both Dean and Rod have said, overall there definitely appears to be more confidence around growth and the market outlook, despite the obvious challenges presented by commodity prices and pressure from the retailers. This is taken into account that the majority of the respondents in the survey were manufacturers. A much higher proportion of the respondents, so we've already covered the stats, but almost 60% versus 37% last year, expect the market to improve, whereas a proportion expecting it to worsen. Increased consumer confidence this year, though, doesn't necessarily reflect the reliance on consumer spending in the sector, which may start to dip when the interest rates begin to rise, especially against the backdrop of inflation falling. So moving on to M&A in 2013. The respondents indicate that M&A would present a route to growth in 2014. It was broadly in line with last year, but only a third of those respondents said that there was an increased willingness to make acquisitions in order to grow. This reduced focus on M&A, supported by an overall reduction of 21% in deal volume in 2013 compared to the previous year. This is the first annual decline since 2009. Disclosed deal value also fell. This fall off in deal activity suggests that companies might be holding off on acquisition plans to continue to focus on improving operational efficiency, delivering organic business growth, and in addition could well be a reflection of uncertainty around the benefits that would be gained through acquisition. After all, it is a relatively risky strategy, acquiring and integrating a business. There were also an influx of overseas buyers again in 2013, though the numbers did reduce slightly, with 22% of deals involving overseas acquirers compared to 2009 within the UK. Many of the transactions involving overseas players were high value, including Japanese-owned Suntory's $1.35 billion acquisition of GlaxoSmithKline's Ribena and Lucozade brands, and also Ontario Teachers' Pension Plan acquisition of Burton Foods for $350 million from Apollo Global Management. Both deals were focused on the globalization of brands, the utilization of an existing distribution network in the case of Suntory, and in the case of Burton's, creating a more competitive cost base. In addition, Hain Celestial, a US-based corporate, continued on the acquisition trail into the UK in 2013, acquiring Ella's Kitchen, an organic baby food business with presence in the UK, the US and Scandinavia. And earlier this year, they have also acquired Tilda Rice, which is a microwavable, ready-to-eat rice product. Each of these purchases were focused around convenience, which is a key trend highlighted by the confidence survey. This is a trend that we certainly expect to see continue in the UK and abroad as consumers have less time but demand high quality snacks and meal solutions. Moving on to the emerging markets, which both Rod and Dean have touched on. It's definitely interesting to note that confidence amongst the respondents in continental European markets has fallen in favour of the Asian and North American export markets. This is where a number of the overseas buyers in 2013 were based. Respondents' plans for overseas growth were in line with 2013, but the view on which of the emerging market countries this would come from is broadened, as Dean touched on earlier. Less respondents named China, Brazil and Russia in favour of the likes of Nigeria and Turkey. Nigeria's economy is the most populous country in the West African region. It's set to grow further in 2014. It's no surprise that that's featured. Moving on to another key topic, which for me came out of the survey, which was around diversification. Over 54% of the companies that responded are looking to increase their investment into growing multi-channel routes to market. Last year's survey was more specific around which of the channels that investment would be made into, and online was the most popular last year. These results prove that diversification is still firmly on the agenda, and this has been supported by deal activity. For example, in the lower mid-market, Edward Billington's acquisition of TSC Foods in February 2014 supported their further expansion into food service, gave them access to another major retailer and a retail brand. We certainly expect to see more food players striving to diversify away from the retailers in 2014. Respondents to last year's survey were slightly more bullish about the level of anticipated growth, and this is no surprise, especially against the backdrop of severe competition, price-led promotions amongst the major retailers as they struggle to hang on to the market share, having already lost some ground to the discounters. So the PE perspective, there were a number of underlying trends to come out from last year's M&A activity, most notably the increased level of private equity activity in the sector. For the full year, the total value of private equity-backed deals in 2013 increased fourfold on 2012. A number of the largest global deals in the sector were private equity backed in 2013. In October, for example, Campbell Soup Co. sold its European soup and sauces business to CVC Capital Partners for $341.5 million. And not forgetting the Berkshire Hathaway and Brazilian-based 3G Capital's acquisition of HJ Heinz for $27 billion, which was the largest buyout in US history, more than 3 times the size of the next largest transaction. The consumer space proved to be resilient throughout the recession, which has attracted private equity right across the sector. Businesses with strong brands, a niche position, or defendable own label offering continue to attract interest from private equity, especially where there is a strong management team and the opportunity to build scale. These are the areas of the sector that we at Palatine are focused on, in addition to businesses tracking trends such as convenience, free from, functional foods, although that's by no means an exhaustive list. There's some of kind of the key trends and growth areas that certainly interest us. From a perspective of finding the deals, sourcing the opportunity is definitely not an easy task. The challenge for private equity is to pay the right price for assets in order to generate the required return to investors. And against the backdrop of increasingly cash-rich corporates with strategic benefits and synergies, paying the right price is becoming increasingly challenging. At Palatine, we do expect the market to become more competitive in 2014, but we see the route to generating deal flow as a long-term investment in building relationships with businesses early on in their growth journey. Our approach is to proactively meet with businesses early in their cycle to understand long-term objectives and establish how and where value can be added. So moving back to the M&A focus around what's driving that, we certainly saw more divestments last year and a focus on optimising asset portfolios in large corporates and listed entities. Driven by pressure from investors to reposition the business is creating more activity from large consumer products groups where assets are no longer core to their strategy. There's been considerable interest, again, in these well-managed, relatively well-financed assets. For example, Hormel's acquisition of the Skippy peanut butter brand from Unilever in January 2013, and Genius's acquisition of Finsbury's Lidwell business in February 2013. Both are examples of that. In many cases, the cash released by the sales has been reinvested into the emerging markets and high-margin niche areas, such as functional, which again is a focus of PE, and health foods. Nestlé's return to a focus on nutritional products included the disposal of the Powerbar brand to US-based Post Holdings and could create further opportunities for divestment. Again, we expect to see more activity and opportunity in this area as portfolios continue to be refocused. Finally, I suppose it goes without saying that there's been a lot more interest in the IPO market. We do expect to see a higher proportion of IPOs as the equity markets become more receptive and other popular consumer brands are taking the route. This may well present a route for exit where there have been challenges in the past. So, for example, there was an exit of a PE backer behind Bargain Booze, who successfully managed to exit the business after around about 7 years of investment through the IPO route. It's certainly back on the agenda, and it's certainly an area in the wake of a number of listings over the past few weeks, AO, and then in the news around Poundland, which was a company that was mentioned earlier, and Pets at Home on the horizon. So I think really to summarise in terms of the key trends, we definitely expect to see more interest from overseas buyers. North America and Asia was most prominent in 2013. Diversification away from retail, given all of the pressures there. And to add to that, there is definitely the export opportunity to facilitate that diversification away. As I've mentioned, increased competition from the private equity perspective, the continuation of non-core divestment, and increase in IPO as an exit route for many different buyers.
Excellent. Thanks, Charlotte. Thank you, Rod, as well. So yeah, you can see that all attendees will be emailed the full confidence survey when it's been compiled. This is the third year of the survey. We're obviously going to continue it as we move forward, and we appreciate both your answers and your attendance today. So thank you very much. Obviously, we're still keen to hear your questions. Some of them have been coming in. So without further ado, I'll hand the floor to our Marketing Director, John Newton.
Yeah, we've had some questions come through. First one, I think is probably one for you, Dean, actually. Which sectors are you seeing the most positive signs from?
I was interested to see Charlotte mention some sectors that Palatine are particularly looking at around free from, for instance, and convenience. Certainly the health and wellness trend is not something that has gone away during the downturn. And some of the sort of industry watchers that I've been speaking to in the last sort of few weeks have mentioned that perhaps this year there will be more of a sort of forensic look at some of the subcategories within health. So free from was going gangbusters, not just here in the UK, but the US and Australia. And you're seeing also a growing interest among food manufacturers to sort of use protein, and that's not just in dairy, but sort of areas around snack bars and cereal as well. So I highlight those two particular areas as sectors that I'm seeing particular growth.
Okay, great. Thank you. Rod, are you still there?
Yeah.
Excellent. We've had a question, I think, probably based on something you were talking about in regards to multi-channel. And yeah. The question's quite short. How can brands best harness the growth of multi-channel, do you think?
Well, I think clearly some of it is to do with who you target in terms of the retailers. Some of it is actually the proposition that you're putting to retailers. And it depends a little bit on whether or not you have a portfolio of brands you're able to work with in a category, or whether you're working with one brand. But it brings up important questions over pack sizing and opportunities to volume load, because a lot of certainly online type purchases will be very large packs. Conversely, of course, if you go to the convenience sector, the reverse is true. But it's about the proposition and tailoring the proposition to the individual outlet. It's about making sure you understand what the service requirements and coverage you've got in the individual channels within the store groups. And it's about also being serious, I think, in terms of which retailers you're targeting and going to. The actual items or what you put centre stage varies so much on the detail of what your offer is, which category you're in, and which retailer you're going after. So I appreciate that's not, at the top level terribly helpful, but that is that's what it's like in terms of making sure that you get distribution across all the different channels. It's actually in the detail of what you're offering in the category and the individual retailers.
Thank you very much, Rod. I think we've got another question for you in a moment based on what you're saying in terms of positioning. So think on for that one. One here that I'm sure will be for Charlotte. Are the opportunities that are in the market at the minute from the food sector, are they sort of stronger than in previous years?
I mean, I think I can only answer that from a mid-market perspective, which is kind of where we focus. And some of the restrictions previously have been around debt capacity, and from a private equity perspective, in some cases, deals have been funded 100% by equity just to get them over the line, with them then subsequently being refinanced. One of the main issues around transactions in terms of our main focus, which would be buyouts historically, has been a lot to do with valuation. And whilst I definitely think there's more opportunities in the market to exit shareholders who've been sat within a business for a long time and are looking to kind of partially or fully exit, valuation expectations still, there's still some difference between expectations, and also that's being impacted in some respects by other transactions that are happening, which are pushing valuation expectations up. I think one of the major issues is around how cash generative some of the businesses that perform very well have become, because actually in some cases it's better for shareholders within a business who are taking a decent salary or dividend from a business, actually might perceive that it's better just to sit tight, carry on doing what they're doing, rather than realise a value that they might not feel is reflective of the business and the future opportunity for growth. So that's kind of the dichotomy that we face.
Great, thank you very much. So there'll be another question, I think, in a minute for you. Rod, as I mentioned, there was a question, actually, I think there's two that I reckon you could probably answer together. One question is, what should food manufacturers prioritise this year in terms of positioning? And I think there's one that perhaps allows you to give some examples. Another question, you mentioned the need for competitive edge and a differential advantage. Which brands do you think have gone to market with a genuinely differentiated position? And so it may be that you can combine those two together. So what should people be prioritising in terms of positioning, and who's doing positioning well?
Okay. Well, in terms of what to prioritise, as I say, it does depend upon the specific category. So, if you do your consumer research in the category, working out what the core reasons, motivations are that consumers and shoppers are buying in that category, those are things to major on. In terms of how that sort of pans out, you are going to pick up on some of the trends that we've talked about. So it is, I think, going to be things like free from. It's going to be things about locality or provenance or heritage. It will be about taste, things that are quite sustainable in the food categories. These things are tremendously important, and you can see that. If you look at one of the markets I find quite interesting, one of the bigger markets that I find quite interesting, and invariably this is going to be a bit of a UK example, but would be bread. And so you've seen, after the general dive in quality that bread had through the 80s and 90s, you've seen particularly brands like Warburton's, which have come from, I think, a very low level in the 90s, but as they expanded, come to probably take a quarter of the category. And that's fundamentally based around delivering a better loaf. And that's in terms of taste and in terms of meeting different kind of use states for consumers. So I think the trends that we've talked about are going to be important. And I still think that particularly in much of the larger food providers, we've still not seen them tapping into the opportunities that less processed, more natural, more free from positioning would offer them.
Fantastic. Thank you very much for your answer there, Rod. So I think we've got time for one more question. This is for Charlotte. And the question is, have the reasons why food companies have been seeking private equity money changed over the last 5 years, do you believe?
It's a good question. I don't necessarily think the motivation as to why a private equity deal might work more so than a trade deal, for example, have changed. I think what I was saying earlier around the challenges on valuation, especially when you compare the perception that trade, and it often is the case that trade can offer a better price because of the strategic benefits in some cases. I certainly think food businesses have become more aware of what the requirements of private equity are, and as a result of that, probably a bit more educated in terms of what they would need to do to fit around the private equity deal. So, what's important for private equity to work. Growth is very important, but probably more so than anything else, management team is. And what's happened during the course of the recession over the last few years is that people have really started to invest in management teams. Not in all cases, there's still succession issues in quite a lot of businesses actually, but investing in good, strong management teams has meant that those businesses are actually much better able to kind of fit with the private equity approach. And I think people also want the opportunity to kind of go again. There might be some kind of older, latent shareholders sat within a business that aren't necessarily strategically involved or operationally involved in the business, given they've had to stay in the business because they've not had the obvious exit route over the past few years. So I don't think it answers your question perfectly, but I do think kind of I think really the reasons haven't changed, but people have become more focused as to what they need to do to create an exit for themselves.
Fantastic. Thank you very much. Thank you very much for all your questions, and of course for completing the survey. Handing over to Dean.
Yeah, just a final thanks from me, everyone, and wishing you a very good weekend, and we hope to see you again on future webinars on Just Food. Thank you.